On Thursday, the European Central Bank meets to decide how much support they need to give to the European economy. This matters because the ECB is buying a very large amount of bonds from private investors in order to keep interest rates artificially low. The discussion that will take place at the ECB on Thursday will be to what degree that those purchases need to be scaled back. As the European recovery firms up, the natural reaction in interest rates will normally be to rise. The debate is to what degree would that rise in interest rates damage the European economy, and to what degree that rise in interest rate is just warranted by better economic conditions. The question is, how much do they need to keep buying bonds at the current rate? We think they will largely try to ignore that question because there are some divisions on the Governing Council of the ECB. How much should it matter for interest rates? In the grand scheme of things, not too much. We think that market forces should regain a foothold and that interest rates should increase regardless of the decision that the ECB takes. We expect 10-year interest rate, to use that as an example, for example, in Germany, to rise by another 30 to 40 basis points by the end of the year. It's significant, but compared to where we were in the previous economic cycle, it is still very limited. And we would argue that after the rise this year, there isn't much more increases to be had. Where it does matter, however, is we think for what we call higher yielding fixed income bonds, we think that more demand is going to be displaced into higher yielding alternatives, for example, riskier sovereigns or credit bonds. So the increase we're expecting is still going to be way below where we were in the previous cycle, as we said, and this is something that both financial markets and the economy should be able to take fairly easily.